Okay, students, today we are going to talk about chapter number 4. In chapter number 4, we have selected to do a problem 431A. In this problem, we are going to prepare a worksheet, a financial statements, and closing entries. The unadjusted trial balance of this investment firm has been provided to us over here. Even though you may look here and say, well, the debits are equal to credit, so this should not be unadjusted trial balance. So, but if you look at closely, you see the service revenue is there, supplies expenses are missing, and there are salaries payable information, for example, is missing. So we have to find out what are the missing numbers. So how are we going to find out if somebody has given you at work this trial balance? You may get confused when you look at all debits are credit equals to credit, so it should be an adjusted trial balance. However, the accountant, your senior accountant, will provide you a few other things. And the few other things are the adjustment data. So they will going to provide you, these are the 5 pieces of data that needs to be adjusted. And then at the end, they will tell you have to prepare a worksheet, you have to prepare an income statement, a statement of retained earnings, balance sheet, and you have to prepare your closing entries. And here they give you a total asset as to check your answer that your total assets should not be more than $106,000 and 500. So let's start working on it. I am going to make a sheet in this direction, and then I will make sure that you should be able to see it. So we're going to put the name on the very top, which is Farish Investments. And then we'll just name worksheet and the date December 31st 2024. On this left hand side of the sheet, I will list all the accounts that have been provided to me in this unadjusted trial balance. So for example, I will just draw a line here, and then I will draw another vertical line, and I will make sure I will put the account name here, and I will list them in the same order as I have over here, in the same from cash all the way to depreciation expense. So I will enter this information as cash, and then account receivable, I'm just putting AR, and then office supplies, and then equipment, and then accumulated depreciation, I'm just putting AD. For equipment, I'm just putting equip. I don't have enough room here. Then accounts payable, AP, and then salaries, I'm just going to put a P, payable, and then unearned revenue, I'm just REV, and then notes payable, I'm just put NP, and then common stock, I'm just put C/S, then retained earnings, I'm just going to put RE, and then dividends, and then service revenue, and then I'm going just to leave one small area here. I will tell you why. Then we have insurance, and then we have insurance expense. I'm just putting in an abbreviated form here. And then we have salaries, expense, and then supplies, expense, and then interest, expense, and then rent, expense, and then depreciation expense for our equipment. And then we're going to leave a line here, and then we say total. Okay, so first we will copy the information that has been given to us, because this is unadjusted trial balance. So we're going to say unadjusted trial balance, and we're going to say put it over here, debit, DR, and credit. So we're going to make a column here. I hope that you will excuse my wavy lines. I don't happen to have a scale in my hand right now. All right, so what is the balance of the cash? We know the cash balance is $30,000 given on the debit side. So we're going to put this $30,000 over here. Then the next thing, we have given account receivable for $51,000. So we can put $51,000 over here. Then we have office supplies, $7,000. We're going to put the $7,000 over here. We have equipment given to us, $28,000. We're going to put the $28,000 equipment. And all of those were in the debit side, as you can see, and I put it on the debit side. The accumulated depreciation of $9,000 is in the credit because it's a contra account, runs opposite of this. So it's in the $9,000 over here. Then accounts payable, $13,000 will be on the credit side. And then we have salaries payable, no information given, so we leave it empty. And unearned revenue, we have $5,500. So we're going to put unearned revenue $5,500, and either salaries payable I left it blank. Notes payable, we have 21,000, so we leave it here, 21,000. And then we have common stock, 27,000. We put 27,000 in the common stock. And retained earnings we have at 29,500. And then dividends we paid this year was $29,000. So they go on the debit side. So I am putting on the debit side. So far I'm just copying the data that has been given to us. Service revenue is $93,000. And then insurance expense has been given to me as $2,500. And then salaries expense given as $40,000. And then supplies expense is not given to us, so we leave it as it is. And then we have interest expense of $5,500. And then we have rent expense of $5,000. And we have been given a no information on depreciation expense, and the total is given to us as $198,000 on both sides. Correct. Now we are going to see what are our adjustments. So over here we're going to divide this into adjustments, and we will make a column debit and credit here. So this is our adjustments going to be, and this is our debit and credit. All right, so we will start with the first one. So here in this question, it says unearned revenue earned during the year $800. So whatever unearned revenue you have is $800. So let's see what unearned revenue we had. So according to this question, the unearned revenue is given to us as $5,500, right? So I'm going to show you on another piece of paper using a T account, and let's make it on the back of it so it's easy go together. So here is our unearned revenue. So the balance at the beginning of the year is given to us as $5,500. So that's the beginning balance. During the year, according to this one, unearned revenue earned, the word earned, during the $800. So we earned $800. So how much left? $4,700. So that is our ending balance for our balance sheet, because as you know, it is a liability. All right, so this is our part A. We did it. So we have earned $800. So where this $800 is gonna go? The $800 is gonna go right here. So over here we have $5,500 unearned revenue. So we have earned $800. So if you want to see the journal entry that I have showed you in the previous lecture, you can say that debit unearned revenue for $800, and you're going to credit revenue or service revenue for $800. So you are debiting $800 of revenue, unearned revenue here, and then in a service revenue you are crediting over here under service revenue $800. Okay, that's what we have to do for part A. Let's see what part B is saying. Part B is saying office supplies on hand is $4,500. $4,500 on hand means they gave you the ending balance. They told you what is the ending balance. So if we go over here and if we do a part B and we say office supplies, which is an asset, debit and credit. So they say the ending balance of the office supplies on hand is $4,500. All right. So this is my ending balance, $4,500, right? So what is my beginning balance? Let's see over here to find out what's the beginning balance. So if you look at office supplies, the beginning balance is $7,000. So if your beginning balance was $7,000, ending balance is $4,500. So how much you have used? The difference of these two is $2,500 used. Used means they become expense. So we can say debit supplies expense is $2,500, and we're going to credit office supplies, the asset, for $2,500. All right. So usually we use a word purchase over here. So how much is purchase? The purchase was 0 because we didn't purchase anything this year. All right. Very good. So let's see where we have to put this information over here. So where is our office supplies listed? So office supplies are listed here. So that means we have to credit for $2,500 because we have used it, but we also have to put it in office supplies expense. See, office supplies expense is here. So we have to put $2,500. Oh, not here, but here in the adjustment. Apologies for doing this. So you notice the 800 debit here, credit here, debit here. All right, let's move to number 3. In number 3 of part C says depreciation for the year is $4,500. So they tell you that the depreciation for the equipment this year is $4,500. So if we go here, so where are we going to put $4,500? So we have to put $4,500 as a depreciation expense, $4,500 over here. So now where I am going to put the accumulated depreciation. So accumulated depreciation is listed here. So we will put the accumulated depreciation here on the credit side, $4,500. That means the next year your accumulated depreciation total or beginning balance would be 9,000 plus the 4,500, 13,500. All right. Now let's look at and also if you want to make a journal entry for it, or if you want to see a T account to look at this accumulated depreciation. Here is a credit, here is a debit. Your beginning balance was 9,000. This year is 4,500. Am I right? It's 4,500. So this was the beginning balance depreciation for this year, and the ending balance of this account would be 13,500. And if you want to know how did you make a journal entry, debit depreciation expense for 4,500 and credit accumulated depreciation for $4,500. That will be a journal entry. This will be a T account for part C. Okay, and we have already put this information over here. So let's go to part D. In part D, they are talking about accrued salaries expense for 400. What accrued salary means? Accrued means you have incurred, but you haven't paid it yet. Means you owe your employees $5,000 because they have already worked for you, but you haven't paid it. So how we are going to tackle this thing? So let's go over here. Now we have to look for salary expense. Now the salary expense is listed over here, right? Salaries expense $45,000. And now you have to do another salaries expense because you have not paid. So how much was it? Accrued salary expense $5,000. So we have to add debit $5,000, but we also have to look for $5,000 in terms of salaries payable. So if we go up here, we see salary payable of $5,000. So when we have this kind of situation, what we do, we always say the salaries, accrued salary is debit salary expense $5,000, credit salary payable $5,000. It simply means the employees has already worked for you, but you haven't paid them yet. You still owe them $5,000. All right, let's go part E. Accrued service revenue $6,500. What accrued service revenue means? It means you have provided the service to your customers, but your customer hasn't paid it yet. So accrued service revenue would be debit account receivable for $6,500, and you're going to credit service revenue for $6,500. All right. So what does it mean here? You have provided the service to your clients, but they haven't paid it yet. So we are going to enter this information. So here we have account received $51,000. So we're going to add $6,500 here. And then we have to add the $6,500 to our revenue. So where is our revenue? The revenue is listed here, $93,000, and in that $93,000 we had added a $800 from the previous unearned revenue, and we are going to add another one, $6,500 on this side. Now we are going to calculate the total. So what is the total for everything on this side? So we have 6,500. So we add 6,500 plus 800 plus 5,000 plus 2,500 plus 4,500. It's 19,300. So we have a total of 19,300. And then we look for the total on the debit side, which is very similar. So we know that is going to be 19,300, but we can try. It's 2,500 plus 2,500 plus 4,500 plus 5,800, 6,500. It turns out to be 19,300. So that here is the total. Now we have done these adjustments. So first is a trial balance, which is unadjusted, then the adjustments, and then it gives us adjusted trial balance. So we would say adjusted trial balance, and then we again make a debit and credit column, and we simply add these things. So cash is still $30,000 because there is not such thing add or subtract, so we leave it at $30,000. Then we have account receivable 51,000 and 6,500, so that will become 57,500. All right, then we have office supplies 7,000 we start with. Now we used 2,500, so 7,000 debit, 2,500 credit, it will give us 4,500, the ending balance we talked about earlier. Equipment was purchased as $28,000, will remain at $28,000. Okay. The next one is accumulated depreciation. It was $9,000. We have another $4,500. So this will become $13,500. Now you can also see that this is credit, this is credit. So when we add credit to credit, it will be an addition. Then we have accounts payable $13,000. We don't have anything. So our accounts payable remain at $13,000. Here we have salaries expense. We didn't have we have 0. We have 5,000. So they will become $5,000. We have unearned revenue of 5,500. We earned $800, so that it reduced the balance by 800. So we left with $4,700, which we have already shown you how to calculate. Notes payable was 21,000, remain at 21,000, no change. Common stock, it was 27,000, no change, so it's 27,000. Retained earnings is 29,500, sorry, 99,500, and so right now there is no change. It's 29,500. We will, when we make the statement of retained earnings, we will see those changes. All right, so we have a dividends of $29,000, no change in the dividend here, so it remains at 29,000. Service revenue was 93,000. Now we have 800 and 6,500. So when we total these two, we will get 103,000. So we say 93,000 plus 800 plus 6,500 is 100,300. So we just put service revenue 100,300. Okay, so we add these two with this one. Okay, then we have insurance expense 2500, no adjustment, so it will remain at 2500. Sorry, on this side 2500. And then salary expense was 4000, 40,000 and 5,000, so that will be 45,000. And supplies expense was 0, now it's 2500, so we have 2500. Interest expense was 5500, it remains at 5500, there is no change here. Rent expense was 5000, will remain at 5000, and depreciation expense is 4500, so it's remain at 4500. All right, so now what we're going to do, we're going to calculate the total on the debit side and total on the credit side. So we starts with 30,000 plus 57,500, 4,500, 28,000, 2,500, 4,005, 2,500, 5,500, and then 5,000, and then 4,500, so it's 185,000. Looks like I made a mistake somewhere, so let's calculate it again. So cash is 30,000 plus 57,500 is our account receivable, then 4,500 is our office supplies, and 28,000 is equipment, and then we have 29,000 dividend, then we have 2,500 among insurance expense, 45,000 in salaries expense, 2,500 in supplies expense, and 5,500 in interest expense. Rent expense is 5,000, and then 4,500 in, so we got $214,000. So the total is 214,000. And then we can calculate the similar thing on the credit side. It starts with 13,500 plus 13,000, then 5,000, then 4,700, then 21,000, 27,000, 29,500, 100, 300, so 214,000. So now we can say after all the adjustment, our trial balance is adjusted, and with the help of this trial balance we can make a income statement. All right, so let's make an income statement here. Again, we make two columns, debit and credit. Debit on this side, credit on this side. All right, so the first item on our income statement is service revenue. So here is our service revenue. So I'm going to extend this. Let's just make another one for balance sheet over here. So we're going to put 103,000. I am just simply copying this number over here to 103,000. That's all I'm going to do in this step, just copying this number from the adjusted trial balance 100,300 over here. So income statement is all about revenue and expense. So we copy the revenue. Now the next thing we're going to copy is all the expenses. So the first expense we have is $2,500. It's the insurance expense. The next one is salary expense of $45,000. So we're going to add 40,000, copy 40,000 over here. And then we have supplies expense of 2,500, just copying over here. Then we have an insurance expense of 5,500, they copy this, and then, sorry, interest expense, not the insurance expense. Insurance expense was already $2,500, rent expense $5,000, and depreciation expense of $4,500. Now what we're going to do is we're going to total. So if we total this side, it turns out to be 103,000. Sorry, I made a mistake in writing. Is 100,300. So it's 100,300, and let's add all the expenses. 2,500, 45,000, 2,500, 5,500, 5,000, and 4,500. So it's 65,000. So this year you have a total expense of $65,000 in comparison with your revenue of 100,300. And as you know that the net income is revenue minus expense, so we can say this net income, the difference here between these two, is $35,300. All right, $35,300, and if you total this side is 100,300, and if you total this side is 100,300. Okay, this is 3. Okay, now we made the income statement. Now we are going to make the balance sheet. Now balance sheet you are familiar with. It has all assets, liabilities, and equity. So first we list all the assets. So we have asset, the first asset is over here. We have is cash. So cash is $30,000. And then we have account receivable, which is 57,500. Then we have office supplies of 4,500. And then we have equipment of $28,000. And then we have accumulated depreciation, which is going to go here, is 13,500. Then we have $13,000 accounts payable. Then we have $5,000 in salaries payable. Then we have $4,700 in unearned revenue, and we have $21,000 in notes payable, $27,000 in common stock, and dividend we have is $29,000. So we have a 29,500 is our retained earnings, and we have a dividend of 29,000 on this side of dividend. Okay, so if you calculate this on the debit side, your total turns out to be, let's do this, 30,000 in cash plus 57,500 for account receivable, 4,500 for office supplies, and then 28,000 for equipment, and 29,000 for dividend. So it's 149,000 on this side. And then we're going to calculate the other side, which is 13,500 accumulated depreciation plus 13,000 notes accounts payable and salaries payable of 5,000, and then 4,700 of earned revenue, and 21,000 of notes payable, and 27,000 of retained earnings, and 29,500 of retained earnings. So that turns out to be, I think we calculated incorrectly. 13,500, 13,000, 5,000, 4,700, 21,000, 27,000, and 29,500. 113,700 is the correct number. So all the credit side, you are this and this one. So what does it mean? When you add this 35,300 net income over here on the credit side, 35,300, you will see it, you will come out to be 149,500. So if you add 35,300, it's 149,000. Those side. But we'll show you further how these numbers turns out when we make the go to requirement number 2. So this is just a worksheet before you have to make. Just imagine a company like Walmart or ExxonMobil or Bank of America, how big their worksheets turns out to be. We just making for a very small firm. Let's see what requirement number 2. So that was the requirement number 1 we just completed. The second is prepare income statement, statement of retained earning, and classified balance sheet in account format. So what we have to do next is to prepare these 3 statements, and we'll go from there. All right. So the first thing we have to prepare is the income statement, and I'm going to use a different sheet. So Farish investment, income statement, from January 1st to December 31st, whatever the year is, and we're going to make this. So first thing, always, as we told you, goes to revenue. Among the revenue, we call it a service revenue, and the service revenue is how much we have calculated. We have calculated a service revenue of 100,300. So that is 100,300. Now we have to put expenses. What expenses we have? The first one we have is insurance expense. Of $2,500. So first expense is a salaries expense. Our salaries expense is 45,000, so we have 45,000. Before that we have insurance expense. I forgot to put it. Insurance expense is 2,500. And then we have supplies expense. We have supplies expense of 2,500. Then we have interest expense of 5,500, and then we have rent expense of 5,000, and then we have depreciation expense of 4,500. So we're going to put a total expense So we calculate total expenses, turns out to be 65,000. We have calculated earlier. So our net income turns out to be $35,300 that we have calculated. So this is our net income. Net income is 35,000. All right. Next thing we have to make is a statement of retained earning. So it's Farish investment. A statement of retained earning. Earnings as of December 31st. So we have a retained earnings as of 1/1. So what is the beginning balance of retained earnings? We can go back to the question. The retained earnings were $29,500. So this was $29,500. And then we add the net income, which we have just calculated, for $35,300. So that give us a total of $64,800. And then we subtract the dividends that we have paid. How much dividends we have? The dividends we have is 29,000. So we subtract 29,000 and we left with retained earning as of December 31st is $35,800. So that is your statement of retained earnings. This number came from exactly from here, and this number dividend was provided in the question. Okay, the next thing we have to do is to build a balance sheet. So we are going to build a balance sheet. So Frank investment balance sheet as of December 31st. We list asset on this side. What assets we have? Basically cash that was given to us $30,000. Then we have account receivable. We calculated over here. Our account receivable final balance was, sorry, here $57,500. Then we have office supplies, which we have calculated over here, 4,500. And then we have that's about and then we have equipment. Equipment we have is $28,000. And then we have accumulated depreciation minus accumulated depreciation, which was 13,500. Sometimes what we call these three as current or assets, or these are called long-term assets. The difference here, the current asset has a life of less than 1 year. Life is less than 1 year, and the current long-term asset has a life greater than 1 year. So if you want to calculate these three separately, so your total current assets will be 30,000 plus 57,500 plus 4,500 is 30,000 plus 57,500 plus 4,500 is 92,000. So these total is 92,000, and the total of these after subtracting this number is 28,000 minus 13,000 is 14,500, and hence your total assets is 92,000 plus 14,500 would be 106,500. And you can see that in your question they have provided you the total asset, which turns out to be 106,500. But in real life nobody provides you this number. This is just for your problem that here we are showing you. Okay, the next thing we have to calculate in the is the liabilities. Liabilities are also signifies as current and long-term liabilities. Current liabilities has a life of less than 1 year, means they are due within a year, next 1 year, and long-term liabilities which are due over more than 1 year. So the first is accounts payable that we have calculated as 13,000. Then we have salaries payable that we have calculated as 5,000, and then we have unearned revenue for 4,700, and that gives us total current liabilities of 22,700. So that's your total current liabilities. And the long-term liabilities, you have these three long-term liabilities. You have a notes payable for $21,000. So your total liabilities is 43,700. That's your total liabilities. Then we have stockholders equity, or simply equity. Under equity we have two accounts available here: common stock and retained earnings. Common stock, we already know, we have information was given to us, is 27,000, and the retained earning we just calculated on previous page was 35,800. So we add 35,800, and the total equity turns out to be 62,800. Now you remember the formula: total asset is equal to total liabilities plus total equity. Total asset is 106,500. Total liabilities is 43,700, and plus total equity, it turns out to be 62,800. So if you add these two numbers, 43,700 plus 62,800, 43,700 plus 62,800 is equal to 106,500. So which means your balance sheet is has no mistakes, and SU may probably made no mistakes, and this is correct. Okay, so now let's see what they want in part 3 of the requirement. The part 3 is asking you to prepare closing entries. So what do we do in closing entries? Closing entries process is very similar. Okay, so first thing, let me show you that you made an income statement. So you put all the revenues, you pull out all the expense, and you say the net income is 35,300. And then you take this $35,300, you add with the retained earnings, and you calculate it after subtracting the dividends, the ending balance of the retained earning. This process, doing this process, is called closing the income statement into a balance sheet. So where this ending balance of retained earning goes? It goes right over here from retained earning, statement of retained earning. Right, this number is coming. So this process is called closing the income statement into the balance sheet. Now what I am going to show you is what journal entries you have to do and what accounts you have to use. The account name may a little differ from company to company, but most companies use this account. So you notice that our service revenue is listed on the credit side. See, this is a credit side, this is a debit side, and this is the credit side. So what we are doing in the closing requirement number 3, so it's our requirement number 3, we are closing the so the first we're going to debit service revenue of 100,300, and we're going to credit a temporary account, a transitional account, not transactional, transitional account, income summary of 100,300. So when we are closing our revenue, we close into income summary, we credit this, and I'm going to show you further that you will understand. And then when we close all the expense account, what we do, we debit the income summary account for total of expense $65,000, which we have already calculated income, and then we list credit all the individual accounts such as insurance expense 2,500, and you can list them in any way you in any credit salaries expense 45,000, credit supplies expense of 2,500, and then we have interest expense of 5,500, and then rent expense of 5,000, and depreciation expense of 4,500. So this is to close, this one is to close revenue account, and this one is to close expense account or accounts. Okay, so now we have closed. Then we debit income summary for 35,300, which is and then we credit retained earnings. What was 35,300? 35,300 was our net income. So to close income summary, and then we debit retained earnings for 29,000, and we credit dividends for 29,000 to close dividends. Let me show you the whole thing in a T account. Okay, so suppose this is your revenue account, 103,000. This is debit and this is credit. And here are your expense account. Let's say insurance expense, debit, credit, and your insurance expense is 2,500. Then you have another one, salary expense, credit, debit, and it's 45,000. And then you have supplies expense and you have 2,500, and then you have another expense account, interest expense, which is 5,500. And remember, debit left side, credit right side. Then you have another one is called rent expense, and that is 5,000. And you have depreciation expense, that is 4,500. And then you have a dividend. Let's make it over here. Dividend also has a debit balance of 29,000. Okay, so here is your income summary account. So what you did over here, you debit the service revenue for 100,300. Oh, sorry, 100,300. You debited it, and so when you debit this, you credit this 100,300. So when debits and credits are equal, they zero out, they cancel. Same thing you did on the debit side, you put it on the credit side to close it. So if you're putting a credit side, you're putting a debit side over here. Same thing over here, you're putting on a credit side 45,000, so you're putting it 45,000 on the debit side. It's zero out. You're putting the credit over here 2,500, so putting a 2,500 here, and then 5,500 over here to cancel it out. 5,500 goes over here, and then 5,000 over here to zero out, so 5,000 over here, and then 4,500 over here to zero it out, so 4,500. So now you add all of this, it turns out to be 65,000, and you total this is 100,300, and the difference of this two is 35,300. So this is this 3,500 that we have added on over here, and that's how it gets over here. So in order to put over here 35,300, you have to do this. You debit the income summary account for 35,300, and you credit the retained earning account for 35,300. And it also already had a balance of 29,500 from the beginning. It gets 64,800 over here. Now you have a dividend account, you have to close this. So you close this by putting 29,000 this side, and then you put 29,000 in the debit side on over here. So that's how you get the ending balance of $35,800. I know it's a lot. It's almost an hour video, and you will take a time, but if you watch this video multiple times and you go through these notes and you see what I am doing while I'm talking, you will notice this is a very comprehensive problem, and all these 4 problems that I have done today, I'm gonna post, is gonna help you learn the mechanics or the method for doing your homework, your quizzes, your exams, and also for your project for accounting cycle. Make sure, please do watch these videos, the videos that I am providing you, the videos that is provided by the author, and go through the notes, read a book chapter at least one, go through the PowerPoint. Make sure you practice, because accounting cycle project has unlimited attempts on it. So don't worry about making a mistake. The more mistakes you're going to make, the more you're going to learn. Again, thank you for watching this. I hope to see you in next video.